Good afternoon. Welcome to the Master Investor panel discussion on the democratization of financial services. My name is Richard Berry. I'm the founder of the Good Money Guide. I'm joined by Kirsty Grant of Seedrs, Rezaah Ahmad of WiseAlpha, and Tim Levene, CEO of Augmentum Venture Capitalists. I'll just tell you a little bit about myself, and then we'll go through the panel. They can introduce themselves and tell you a little bit about what they do and what their platforms do to democratize financial services. So the Good Money Guide is essentially a comparison site for investment products, trading accounts, and currency transfers. We don't just do that. We cover the news, views, and interview lots of interesting CEOs, including Rezaah up there, and the Seedrs CEO as well. We've spoken to Jeff. We've not bothered Tim yet, but I'm sure we will. We will after this. I'll pass you on to the panel now, starting with Kirsty, Chief Investment Officer of Seedrs. Kirsty, would you just like to introduce yourself and tell us a little bit about Seedrs?
Yeah, absolutely. Thanks very much for having me. So Seedrs is the leading pan-European equity crowdfunding platform. So in terms of democratizing finance, that's kind of at the heart of what we're doing is opening up the asset class of private equity to both entrepreneurs seeking capital and to investors who are looking to invest into growth stage and startups businesses.
Okay, excellent. We'll go to Rezaah. Do you want to just quickly tell us, for those of us who haven't seen you at the many conferences, tell us a bit about yourself and WiseAlpha.
Sure. So WiseAlpha is leading the democratization of the corporate bond market through the way that we fractionalize corporate bonds down from chunks of 100,000 into denominations of a penny. We make it affordable for retail investors to buy into corporate bonds of FTSE 250, FTSE 350 size companies, and therefore, generate returns of 5 to 8% and get the same access to bond opportunities that are easily available to institutional investors.
Okay, and Tim Levene, do you want to give us a quick introduction about yourself and what you do?
Absolutely. I'm the CEO of Augmentum Fintech. What makes us unusual, we are a venture capital investor specialized in fintech, and we typically invest with companies that are Series A or later, but we are publicly listed. So what we have looked to do is really open up this asset class to retail investors as well as institutional investors. But a lot of our institutional investors would be wealth managers who are managing money on behalf of mass affluent and high net worths as well. Typically, venture has been the preserve of endowments, institutional investors, pension funds. So an unusual structure and one in which we will see more of over the years.
Okay, so 3 slightly different approaches to asset classes that weren't historically available to the average Joe on the street, the average investor. Should we just touch quickly on democratizing financial services? And first of all, is it a good thing? Is it a bad thing? I mean, we're all in this business to help people get access to different markets. But overall, do you think democratizing financial services and giving people access to every single type of investment, bearing in mind all 3 of these are in a sort of fairly high risk asset class, do you think overall it's a good thing? And what should people be wary of when they're looking at new markets? Rezaah, Kirsty, why don't we start with you?
Sure. Yeah. I do think it's a good thing to be opening up these asset classes, provided we do so in a transparent and efficient way. And certainly, what we're looking to do is ensure that investors who understand the risks have access to the asset class. So while we are open to retail investors, they do need to qualify themselves when they sign up to Seedrs to show that they understand what it means to invest in a private business, they understand the risks involved, they understand it's not the same as investing in public stocks. And I think if investors are given that level of information, then it should then be up to them to make that decision for themselves. And frankly, a lot of them are putting their funds at just as much at risk through a number of intermediaries anyway, why shouldn't we sort of empower them to have the information to self-direct and make those decisions?
And actually, Seedrs is quite a good example of that, isn't it? Because 5 or 6 years ago, in the wild west of equity crowdfunding, nobody was regulated, and there were lots of different platforms doing lots of different things. But now you've grown up yourself as a business, haven't you? So do you find that you sort of self-regulated who you let in, or have you worked closely with the regulators on that?
So we were actually the first equity crowdfunding platform to become regulated, and we made sure we had that regulation in place before we sort of started operating in this space. The regulation has since grown up, I think, and evolved to work with the number of platforms that have sort of entered this space. But actually, there's very good financial regulation in the UK, and we're pretty forward thinking in that it's quite principles based rather than rules based. So what we were doing from the start could fit within under and within the existing regulatory framework. We just had to make sure that it worked and we were meeting the principles that the FCA had put in place.
Super. And Rezaah, what about yourself? WiseAlpha is probably fairly interesting for this audience, the master investor audience who like the smaller cap shares, who love a story, who love a brand. Has the democratization of financial services overall been good for you guys?
Yeah, I mean, I think I'm generally of the view that all the key components of a company's capital structure, bonds, equity, any type of debt, these are all so key to the functioning of an efficient and growing economy that all elements of society need to be able to invest, and there needs to be that quality of access. I mean, can you imagine if for example, they turned off the stock market for retail investors? There'd be uproar. I mean, the way we come at it is the bond market, which is actually bigger than the stock market. And these bonds are issued by the same companies that people can freely invest in the stock of, on numerous stock trading platforms. There's no reason why retail investors shouldn't be able to access bonds in the same easy manner that they can the stock of the company. So, we set about democratizing the space solely, in order to, create a new market for retail investors, and ultimately to bring the entire institutional and retail investor base together. And I think, we've always seen this as the last bastion of fintech, to really develop, because it's, the corporate bond market is still stuck in the same stage as it has been, for the last 30, 40 years. It's just institutional funds dealing with arranging banks in a very small club market. And so, giving somebody the opportunity to buy into Ocado bonds and earn 4%, buy John Lewis bonds and earn 5%, or Netflix and earn 3 or 4%, or even some of the higher risk, bonds yielding upwards of 7, 8, 9%, of major FTSE companies. It's only a great thing for those investors who are interested in building income rather than focusing on capital growth. I think the capital growth and the excitement is more for the equity type investors, which obviously is well represented by the stock market, and companies like Seedrs have done amazingly well in order to democratize that market. And I think there's now a well-established framework in that sector. I think our mission is to do the same for the bond market, and we've made some inroads to date, but we've still got a long way to go in order to build market efficiency, get full access. But I think next year what you'll see is, a full liberalization of that market, because it's just so vital that happens.
Yeah. And what about yourself, Tim? Has it been particularly good for you? Have people been more receptive to investing in a listed VC because there's so much more information about all of these things now?
Yeah, absolutely. I mean, I think it's we've had a golden decade, and I would say what we've seen in financial services, which has been one of the slowest industries, if not the slowest industry to disrupt, and I think regulation plays a real role in that. We've seen an enormous amount of innovative propositions, whether it's Zopa and peer-to-peer lending, Seedrs. WiseAlpha, you know, others.
Have you invested in all of these companies?
Well, some of them, yeah, some of them. I'm not just mentioning the ones we've invested in, but you know, ultimately, what retail investors have missed out on over the past, you know, 50 or 60 years are some extraordinary investment opportunities. It comes back to my previous point of being the preserve of this very small subset of investors. And of course, as industries evolve, you know, the cream ultimately rises to the top. And I think, you know, when you are changing the dynamic, whether it's in lending, whether it's in equity crowdfunding, you know, you need to have those driving from the front, really putting a self-regulated wrapper around themselves, and then ultimately working collaboratively with a regulator, in our case in the UK with the FCA, to ultimately put something in place that, one, protects consumers, but two, allows them to have the opportunity in, you know, in the right way. And I think that's, you know, I think we will see more of that. And one of the reasons the UK has been at the forefront of innovation has been, you know, because the regulator has had a more constructive and forward-looking view, and recognizing that innovation is incredibly important in order to give the consumer and investor better value. I think the one challenge for the retail investor is, if you look at the public markets, there is a real existential risk. You know, we are seeing fewer companies come to the public markets than, you know, than ever before. And if this trend continues over the next 30 or 40 years, we're not going to have a 5100 anymore. Now, I think we all hope that that's not going to be the case. So, you know, what does that mean? I think, you know, one, for us, the attraction to be able to give retail investors exposure to these private assets across a portfolio, and I think that's a really important feature. Whether you're investing in bonds or whether you're investing in private companies, you need that portfolio as well. You need to, you know, articulate to investors that you need diversification. And I think, you know, all of our businesses, you know, offer that. And I think that's an incredibly important feature. But that's certainly, you know, a big challenge for the retail investor and the institutional investor, which is why you're going to see more and more capital in these private markets as well, because of the lack of opportunities in the public markets in terms of new opportunities.
Well, it's an interesting point actually for the retail investor, because, you know, they have a pretty tough time picking investments in the main market where there's lots of information publicly available in a very, you know, in a really regulated environment. You know, for people, you know, just because people should invest in these things, you know, should they? And what's your view on that? Should they be dealing with, you know, a platform like Kirsty's? Sorry, obviously Kirsty will bring you in on this as well, where they, you know, they make their own decisions. Obviously, Seedrs, you've done the due diligence, but you've put it out there, and people go, yes, I like a bit of that, I'll buy that. Or should they instead, or as well, be looking at VCs such as yourself, who obviously, you know, the lay investor probably doesn't understand what makes a startup good or potentially successful, but you obviously do. So you go through that sort of almost vetting process before they go into your portfolio. You know, Seedrs, it's sort of relatively easy to access. Is it as easy to access your investments as well?
Well, I think that's the challenge, and I think it very much depends on the sophistication of the investor, the time that they have. And I think, you know, investors will invest in both, either directly or through a fund, or they might choose to do one or the other. And I think certainly, you know, our underlying retail investors, there will be a mix, you know, of both. But, you know, ultimately, what I often say to our investors, both institutional and retail, is, you know, for you to make an investment decision, you need to have, you know, two things that you're comfortable with. One, that you believe financial services is going to continue to be disrupted over the coming years, and we're at the start of an exciting journey. And two, that we as a manager are going to be, you know, able to identify some of the very best opportunities from a fire hose of deal flow in this market. So if we look at 1,000 opportunities a year, we might well look to invest in only 4 to 5 of them. And that, in our view, gives us the ability to make choice and identify what we think great looks like. And I think that's what, you know, differentiates us. But there are a number of sophisticated investors out there that sit there and say, I have conviction on this particular company, and I don't want to go through a fund. I want to invest directly. And we might have decided one way or another it's not for us. So, you know, I think all the more choice you give investors, let them make the decision, highlight the potential, highlight the risks, and ultimately, that's the exciting thing of the industry that we're all building. The breadth of choice that exists in the market.
And if people want to buy into your fund, how difficult is it? Do they buy shares on the stock market, or do they have to sign up with a placing agent, or apply directly?
No, we're listed on the main market under the ticker AEGM. So, retail investors would buy through their brokers, Interactive Investor, which is another underlying holding of ours, or others.
Nice plug. No, I was having a look. The share price has done rather well over the last sort of year or 2 years. Go back a bit. It's done well. So there's obviously an appetite for it.
Well, he's got some great businesses in his portfolio, of course, to help that share price.
There you go. How about you, Kirsty? How do you get in front of customers? I mean, it's very difficult marketing to people, isn't it? If people want to invest in a fund of startups, they can do that through Tim. If they want to invest directly, they can invest through you. But marketing rules, particularly in financial services, we're all doing great things. You're all providing access to asset classes that you couldn't access before. But if people want to buy through you, how do they do? How do you get in front of people with in the current climate of marketing?
Yeah, sure. And a couple of things that you touched on there. One, you talked about sort of, should a lay investor come onto Seedrs and kind of pick their own stock type thing? And there is a bit of that, someone coming along and wanting to sort of understand the asset class and maybe make some small investments and kind of get in there. But the vast majority of the investment that goes through the platform tends to be either very regular investors on the platform who are rather sophisticated, understand the space, and potentially understand particular industries that they are looking to sort of pick investments in, or they're people that know the business itself rather than coming to see this specifically. So what crowdfunding does is give each business the chance to go out to its audience, whether it's sort of customers, users, etc., early adopters who really understand that business and believe in its future and its success, and give them the chance to invest. And that, as Tim was saying, has a different risk profile and also a different cost profile to investing through a VC, etc., where you might be paying a higher carry fee, for example, for them to, and higher management fees for them to make all those decisions on your behalf. Where the space is also going, that we've started to develop, are these sort of features that start to look a little bit more like your public market. So ways to sort of passively invest in the space, to sort of build a diversified portfolio without having to sit and pick and choose. So
can you automate that?
Yeah, we're in the early days of it. So we've got a couple of features. So we've got an auto invest feature where investors can sort of put aside a pot of money and pick the parameters. So they might want to invest in businesses that are EIS or SEIS eligible, so have these sort of tax benefits that are quite generous in the UK, or there's certain industries, etc. And then as deals come onto the Seedrs platform that meet that criteria, their funds will auto deploy into those funding rounds. So we're getting there in that sense. We've also explored having sort of a fund where you just make sort of one-off investment and then it gets sort of auto-distributed across all deals on the Seedrs platform. So I think we'll see more and more of that sort of the deepening of the space. And
there's and of course, as with all investing, diversification is absolute key, isn't it? There's a great book. I'm such an idiot. I should have looked it up beforehand, but it's written by the ex-chairman of Syndicate Room or something. He wrote a book, and you need to have about 100 startup investments for them. The investing in 10 for one to pay off probably isn't enough. You need sort of between 20 and 100 to really make it
yeah work. Yeah, exactly. So I mean, certainly on our IRR data, I think the overall Seedrs portfolio, the IRR is sort of 15%. But then for the investors, are sort of most regular investors who have portfolios over 20, it sort of jumps up to 30 or 40%. So it's exactly that, and that's sort of what we suggest.
And of course, one of the other big things about putting people into these new markets, just because you can, is also your responsibility to look after them. You look at I don't know how comparable it is, but Airbnb in the rental world. If you wanted to rent a villa in France, traditionally you'd have to deal with a French person and sign their contract and not get your deposit back and things like that. Whereas with Airbnb will look after your money, you look after people's shares, don't you? So you provide a bit of investor protection for people who don't understand the structure of early stage investments. So you, as well as giving people access, you're looking after them as well, aren't you?
Yeah, that's right. Yeah, we run a nominee model where Seedrs acts as the sort of legal shareholder on behalf of investors who invest via the nominee, hold those shares and monitor the investment, and generally enter into documentation that sort of provides the same sort of protections that you would expect of an angel or VC investor.
Okay. And Reza, moving on to you, for those who didn't catch what Reza said about WiseAlpha before, it's a great concept. It's a platform that gives retail investors access to bonds, where traditionally the minimum investment size is 100,000. So if you want to invest in high yielding corporate bonds, and you don't have 100,000, or you have 100,000 and you want to invest in 10, you can do it through Reza's platform through their notes. Do you look after people in the same respect as that? You're giving people access to this sort of slightly higher risk market, where you're obviously, the higher the risk, the higher the potential returns. Do you offer people the same, the same investor protection as well?
So I think in a sense, our structure is not quite a nominee structure, but it's similar in concept in that WiseAlpha holds all the underlying bonds. And we deal with all the corporate actions, or if there are any, what I mean by corporate action is if, there's a consent request, to amend a credit agreement by the borrower, so we make all those decisions in the same way that a nominee would, in Seedrs example for, case, for example. So, from that sense, we simplify the process for investors, by taking care of all the kind of, technical work that needs to be done in terms of maintaining the investment, but, making decisions in their best interests. And then obviously, through all the analytical tools that we have on the site, the reporting that we do, we try to keep people up to date with the latest news, research, financial reports as soon as they're coming out. And, we're working with some very innovative new startups in the high yield arena who are data firms looking to really, bring, real-time access to, company information that comes out, news. So I think, the way that WiseAlpha operates is in order to give all of our investors the kind of information they need, but also make sure their investments are protected in their best interest so they can focus on trading the bonds and making their economic returns.
Okay. And should we just touch on the regulators for a moment? I mean, you don't want to sort of upset them too much, but within the space of high risk investments, there's plenty of sectors where the regulators have just gone, no thanks, that's not for us. Why do you think the regulators have had a particularly positive approach to your types of businesses versus the other industries where they've just gone, no, that's not for us, we're banning it? Tim, why don't you kick that one off?
Yeah, I guess it's really in our underlying businesses parts, and from our perspective, and I go back to my days when we started Betfair over 20 years ago, and I think that was a great example of clearly a business disrupting and disintermediating a very old-fashioned traditional sector that had been slow to adopt technology. And the approach of the bookmakers was to try and put us out of business through regulation. Now, nobody likes a bleating bookmaker. And as such, the regulators said, well, hang on a second, we think this industry is being disrupted for the better. It's bringing consumers a better proposition, better pricing, and ultimately will drive down margins. And I think, the regulator, the FCA, the PRA, the Bank of England have all, and, to be fair, the Treasury and successive governments have all looked at the UK financial services system. And I think clearly the catalyst was post the last financial crisis, and says something has to change here. And we need to stimulate competition. We need to drive innovation. And what has been holding it back, and what really was holding it back, was how stringent regulation was, the cost of being regulated. And I think they had a long, hard look to say, how can we allow this industry to evolve? And I think you need a pragmatic regulator, you need a pragmatic central bank, and you need a supportive government in order to work hand in hand to allow that to happen. Now, that doesn't mean you can play fast and loose with a regulator, but I think bringing in innovative ideas such as a regulatory sandbox, where you can operate in a environment where it is lower touch from a regulatory point of view, but still within a controlled environment, so the regulator can watch and see how consumers are behaving and what might have to be tweaked. And I think, innovative platforms, not just crowdfunding, not just, peer-to-peer lending, but, we've seen a whole raft of interesting investment propositions that have been evolved. And I think not all of them will succeed. But ultimately, what you mustn't do is stifle positive innovation that's ultimately going to make life better for investors, better for consumers, and keep the traditional financial services companies on their toes and force them to improve and evolve as well. So I think we in the UK, have become the benchmark for many others in the world who are looking to evolve their financial services systems. And I think that's a real positive for changing global financial services. And I think the genie is out the bottle. The next big question to answer is what's going to happen with digital currencies, what's going to happen with crypto. And 5 years ago, 9 out of 10 major banks, regulators would have said, this is an industry that we will regulate out of business. And I think you're getting very different answers today.
Well, crypto is a larger discussion that I don't think will fit in here. But so Reza as well. The bond market. It's not for everyone, but it's fantastic at what it does. The regulator's been particularly mean to some bond providers, quite rightly so. But you're working quite nicely with them. Are you happy with the way the regulatory world is covering WiseAlpha?
I think our dialogue is constructive, and we're obviously in a very different segment of the bond market. So we're focused on kind of professionally structured listed corporate bonds, by the large established companies where everything is clear. There's lots of information, so it's a very different market to some of the other bond type products, which like with peer-to-peer lending, have had a very difficult time because they focus their structuring is potentially a lot more looser, less protections for the retail investor. Those types of platforms have kind of drifted into more of the higher risk investment areas, and generally been a bit untransparent. I think there's definitely this a focus now from the regulator on looking at which particular products and niches are the ones and asset classes are the ones which are suitable. Yeah. I think what we've seen through COVID and the short, sharp recession, hopefully a continued bounce back. Let's see. That will weed out the weaker platforms and products from the stronger ones.
Well, I was saying finance that there's two types of business. There's the businesses that are genuinely trying to help people get access to interesting markets, and then there's the business that are just trying to extract money from greedy investors. So Kirsty, what about you? Have you found the regulators fair on the equity crowdfunding side of things?
Yeah, absolutely. I mean, as I touched on before, I really think that we have a very forward-thinking and generally constructive regulatory environment here around financial services. I probably hadn't experienced it back in the pre-crisis, so I don't know how much that was a change here in the UK. But the focus on I guess that position of not just saying no, but looking at, okay, well, what's the benefit to the consumers here, and how can we say yes, but or how can we say yes and kind of add the controls in that we need to see to protect investors and consumers in the market.
Well, that's actually one of the good things about the UK regulator is that they do, they don't mind covering markets that other countries won't. So we are, whilst there are of course hurdles to jump over. We do have a fairly good environment, and it's one of the reasons why London's one of the best places to invest in the world. Should we on slightly jollier things though? Let's talk about sort of personal frustrations within financial services. Talking about democratizing financial services, giving people access to things that you couldn't usually access. We've got about 10 minutes left, so let's just sort of quickly go through. Is there anything you found particularly difficult that is now easy because of opening up financial services?
Is it?
Let's go. Kirsty, let's stick with you.
Is it a bit cute to say private companies?
No, you can say that.
Honestly,
you can say that. You can say that. I think it's a fair point.
It is honestly the reason I joined Seedrs. It was one of those things where you're living in London, you're at the heart of fintech startups, and I just kept talking to friends that were either involved in startups or wanting to be involved, and trying to work out how do you get money to these startups? Like, I want to back these businesses. How do I do it? There just doesn't seem to be a way. And honestly, came across Seedrs and was like, oh, look, Jeff Lynne has literally solved all the problems that I kept coming up against when I thought about how you would make that work. I'm gonna have to back my own horse here.
Yeah, no, you're certainly moving in. I mean, I remember talking to Jeff about 8 years ago about the secondary market for startups. It's the home of setting up a business. The first thing you need is capital. Rezaah, what about yourself? What's been the greatest frustration for you so far?
The greatest frustration. I mean, maybe I should just talk about what kind of I thought was what led me to start WiseAlpha, what I thought was a positive, which drew me to the democratization of financial services. One, I'd seen the way that the cost to run the tech business had been reduced significantly through, the growth in things, companies like Amazon, who've, created the online storage facilities and the connection points online, which have reduced costs quite significantly. I've seen, statements from the regulator citing its commitment to innovation. I'd seen, wonderful startups actually like Seedrs, who were actually making a whole process of investing a lot simpler, and so that era of around kind of 2013, 2014 in the UK was when you started to see all these things mushroom, become, exciting, which all led me to do that. What have I found frustrating? I found, I guess, yes, while there is a pragmatic approach by regulators, there is still quite a lot of red tape, through the regulation that you have to adhere to. And, some of it is appropriate because you do need to protect investors. They do need to understand the risks when they sign up to platforms. But some of it is just excessive, and, it doesn't serve any useful purpose. And so, being able to work with the regulator on an ongoing basis to solve those issues, which will ultimately, in our case, we think we can add billions in value to the consumer in the UK, will be amazing. But at times it is frustrating because you have to work through quite a lot of complex issues, especially when you're doing something for the first time, when you're the one leading the democratization of an asset class. So that is partially frustrating. I think, on the whole, though, I think that everything else that I see in the way that the world is moving is quite exciting. Tech is developing, everything is becoming much more commonly placed, understood. Investors are understanding new products and apps and more efficient ways to do things. So the landscape is becoming a lot easier for it to be conducive for, mass adoption across the open retail space. So, on the whole, I have a very positive outlook for the way things are changing. I just wish things could go a bit faster, in terms of, regulatory boundaries and, things like that. But that's part of the course.
Let's democratize the regulator next. That'll be the next thing. So Tim, what about yourself? I mean, you've obviously invested in a lot of companies professionally and presumably privately as well. What's been your frustration, and who solved it for you?
Well, we're on a journey, and I think we've come a long way, in particular in the last decade. And I think that's incredibly exciting. And what we need to do as an industry is move fast, move aggressively. We can't wait for the regulator. We need to kind of drag the regulator along, which is what we're trying to do. And what I think we still have a long way to go is bringing down the cost of investment as well across the board. I think if we look, to the person on the street, the cost is still too high, especially in the wealth management industry. I think although those costs have come down, I think there is still a long way to go. So I'd like to see that. But I just think the sheer breadth and the choice for investors, it's incredibly exciting. The cost to invest has come down. If I look at my own kind of personal portfolio, I'm invested in, gold. I'm invested in whiskey as an asset class, as well as private companies, as well as consumer loans. I think we've got this great opportunity set out there, and I think the retail investor has never had as much choice and accessibility. And the one thing that I'd like to see continued progression on is continued innovation, but continued reduction in costs to maximize returns for investors across the board, and that will continue to happen the more we can kind of drive innovation.
They are getting there, though, aren't they? Particularly with the early access to wealth management. I mean, it's a key theme that keeps on recurring and recurring, is that people need to invest sooner, they need to invest more, they need to understand the benefits of compounded returns. And there's a few really good robo-advisors out there. I'm not overly keen on the term robo-advisor, but there are a few platforms out there where you can start investing for very low fees and very early on as well, so build good habits.
I think that's right. Yeah, I think that's right. And they've taken a while. The robo-advisors have taken a while to take hold, largely because investors sit there and are waiting for track records. And you can do a lot of things. You can't accelerate time, and that's
yeah. I mean, track records are easy when you're just buying index-linked ETFs, aren't they? It's not, you're not really investing anything else other than the global market. That's fine. I think probably their main issue is are they actually going to make any money and still be around in 10 years? Because that's primarily been the problem, isn't it? That small clients aren't really worth much money to investment platforms unless there's a way to monetize that other than through commissions. I think so. It's a bit of a catch-22. I think we've got about 2 minutes left. Let's just quickly run through next big market. So we've had bonds, we've had startups, we've had venture capitalists. What's the next thing to be democratized through fintech other than cryptocurrency? You can't say cryptocurrency. So let's go, Tim, let's go back to you on that one.
I was going to talk more broadly about digital currencies, but I think one sector.
You can say crypto if you want.
Yes, no, I'm not going to say it. I've already said it, and I think there's plenty of buyer beware stickers to be put around it. I think one industry which is very significant, and I think investors, both retail and institutional, should be looking at, is the insurance industry, because it remains still lost in time. There's been a lot of innovative capital put in. We're yet to see the benefit of a lot of capital. But if you look at the margins, if you look at the inefficiency, if you look at the depth of the revenue pool, I think that's one really exciting market. But today it's disappointed in terms of cut through. But over the next 2 to 3 years, I think you'll see some very significant businesses built in that space.
Okay, that's great. Well, we'll write a guide on how to invest in insurtech with the best ETF and funds to buy. Kirsty, what about yourself? Where do you think is going to be the next big democratization within the fintech world?
Yeah, I mean, insurtech is a good pick. Absolutely, we're seeing a sort of a boom in that area for sure. I guess the other area, not so much a democratization, but I think something that probably needs more consistency is this ESG investing. It's something our investors are focusing on more and more, but it's currently so subjective, and as it probably needs to be in some cases, but having good, transparent and objective measures so that investors who are so inclined can self-direct their investment into businesses that they believe sort of align with their values, I think is something we're going to see more and more of, hopefully.
Did you raise money for Ticker with Tom
Yes.
We interviewed him. Was that you or the other people who were in fact
They're
no longer the other people, are they? They're your friends.
That's right. Yeah.
Because that was quite an interesting.
They're the other people until the day of completion, at which point we will completely change our tune. Yeah. Take a raise with us. Yeah.
And Reza, what about yourself? Let's final word. Next big sector and industry to be opened up.
So, I mean, I think, probably the most important sector, which has been talked about and is being implemented by some fintechs at the moment, it's not really, I wouldn't say I'm talking about an asset class, but what I see as the next big development is in the way that the data that you have in your, that comes from your spending from your bank account, will be used by some of the more modern neobanks to effectively personalize investment choices for yourself, help you with your spending, find better suppliers for some of the products you buy, get better awareness of products which might suit your particular, proclivities. And so, I think what I find is interesting is that there is going to be this new age of tech, which will move further on from the kind of Facebooks and the kind of, social medias of this world, where they've been building a profile about who you are in order to sell you the right advertisements, to a world where if you allow, your neobank to access your data, they'll be able to actually potentially provide you with real-time savings, as well as, very targeted advertising to the products that you need. As well as being able to help you with your saving and investments. And so, it's the overarching big, platform that can effectively plug in lots of different solutions, to provide a wholesale, tailored solution to an individual, which I see as the next big thing. And that's going to have the most impact, I think. Obviously, things like InsurTech are massive. I just wonder whether or not it's more, the tech of it's whether the big guys are the ones who are going to be the beneficiaries of the tech, or whether the new entrepreneurs, with the new companies innovating, whether they're going to be the ones who actually end up dominating the landscape. I think it's going to be a little bit more difficult in that space, just because of the big, capital boundaries. But yes, there's lots still to do, and the bond market, which we're involved in, there's so much potential there. It's huge.
Okay. All right, wonderful. Well, I think that's about all we've got time for. So that was Kirsty Grant, Chief Investment Officer of Seedrs, Rezaah Ahmad, the founder of WiseAlpha, and Tim Levene, CEO of Augmentum. Augmentum. Sorry, you'll have to edit that bit out. They are in their virtual booths. So after this, please do navigate round to their booths, go and say hello, ask them as many questions as you want. I'm sure they'll be delighted to talk to you and tell you more about their offering and how it can help you invest and potentially make some money. So thank you very much, Kirsty, Reza, Tim, for your time, and thank you very much for watching.
Pleasure, Richard.
Thank you. Thanks for
Thanks
having me.
very much.